But Lehman Brothers never knew that their leverage ratio had increased from 24-1 in 2003 to 31-1 by 2007, a staggering 27% increase in just 4 years. This meant that for every dollar of capital, they were taking on $31 in debt. It's a recipe for disaster, and it would ultimately lead to their downfall. As the credit market tightened in the first half of 2008, Lehman's stock lost 73% of its value, and the company was on the brink of collapse. But what really happened? In the months leading up to its bankruptcy, Lehman Brothers was struggling to stay afloat. The company had borrowed significant amounts to fund its investing, and it was holding onto large positions in subprime and other lower-rated mortgage tranches. These investments were toxic, and they would ultimately prove to be the company's undoing. Lehman reported losses of $2.8 billion and decided to raise $6 billion in additional capital by offering new shares, but it was too little, too late. The credit market continued to tighten, and Lehman's stock slid 7% on September 10, after announcing a loss of $3.9 billion and their intent to sell off a majority stake in their investment management business. As the situation continued to deteriorate, Lehman Brothers' parent company, Lehman Brothers Holdings, remained in liquidation until September 28, 2022. But what about the company's customers? Lehman's 110,000 customers received all $106 billion they were owed, a remarkable feat considering the company's financial situation. However, general unsecured creditors received back only $9.4 billion, or 41 cents on the dollar. It's a stark reminder of the risks of investing in a company with such a high leverage ratio. So what really happened to Lehman Brothers? The company's bankruptcy filing remains the largest in U.S. history, involving more than $600 billion in assets. JPMorgan Chase provided Lehman with a total of $138 billion in Federal Reserve-backed advances, but it was not enough to save the company. The Federal Reserve-backed advances were for $87 billion on September 15 and $51 billion on September 16, but Lehman's leverage ratio and toxic investments proved to be too much to overcome. But what about the deal that could have saved Lehman Brothers? Barclays had agreed to acquire the core business of Lehman for $1.3666 billion, but the deal fell through due to a veto by the Bank of England and the UK's Financial Services Authority, FSA. The reason for the veto remains unclear, but it's clear that Lehman Brothers was on the brink of collapse. The company's assets were $680 billion, supported by only $22.5 billion of firm capital, a staggering 30-1 leverage ratio. It was a recipe for disaster, and it ultimately led to the company's downfall. So what's next for Lehman Brothers? The company's assets were sold off to various buyers, including Barclays and Nomura Holdings. Nomura announced its intentions to acquire Lehman Brothers' investment banking and equities businesses in Europe and the Middle East, but the deal was not without controversy. The remaining Lehman estate pursued extensive avoidance and preference actions against financial institutions, trading counterparties, and former business partners to maximize creditor recoveries. But what about the people involved in the Lehman Brothers saga? Richard Fuld, the CEO of Lehman Brothers, was a key figure in the company's downfall. He had taken on significant debt to fund the company's investing, and he had held on to toxic investments that ultimately proved to be the company's undoing. Fuld's leadership was questioned, and he was eventually forced to resign. But what about the other players in the drama? JPMorgan Chase, Barclays, and Nomura Holdings all played key roles in the company's bankruptcy and subsequent sale. So what can we learn from the Lehman Brothers saga? The company's bankruptcy filing remains the largest in U.S. history, and it's a stark reminder of the risks of investing in a company with a high leverage ratio. The toxic investments that Lehman Brothers held on to ultimately proved to be the company's undoing, and it's a cautionary tale for investors and companies alike. The Lehman Brothers saga is a reminder that even the largest and most successful companies can fall victim to the risks of the financial markets. The Lehman Brothers saga is a complex and multifaceted story that involves many players and events. But at its core, it's a story about the risks of the financial markets and the importance of prudent investing. The company's bankruptcy filing remains the largest in U.S. history, and it's a stark reminder of the dangers of taking on too much debt and holding on to toxic investments. As we look back on the Lehman Brothers saga, It's clear that the company's downfall was a result of a combination of factors, including its high leverage ratio, toxic investments, and poor leadership.